It's time. So, all right, good. So we got the doors open. That's good. See if we got anybody waiting. So that's good. Billy, did you get a chance to be outside today? I have been in my office since like 9, maybe before that.
I was outside. I did a lot of driving today. I was in Richmond Park, if you know where that is. Or
Sure.
actually no, you do, because that's where we had the event.
Yeah,
So
exactly.
so actually right before the event, I was actually in Rich Township District 227. There's a lot of people I work with who are teachers there.
Nice.
And then helping them out. So I was there again today. I was in Rich South High School, and then I had to drive to the office. I had to get some, just like things faxed in, printed, just office
Very,
stuff. Then I had to drive
very,
back down. So
very cool. Well, we are going to get started. It is 5:31. We won't jump right into the program. We're going to do a couple things like an introduction and things of that nature. So, first of all, we have with us, we always try to have panelists in here that are people that we trust, people that we would send our clients to, and people, quite honestly, that have the same type of mindset that we do. So, we're bringing Billy Fitzgerald in here. We're going to get his information into the chat. Speaking of the chat, that is the best way for you guys to communicate with us. We love when you ask questions because then we know that you're paying attention. Our class today is really designed to set you up with some basics. For a lot of our folks that are participating in the class today, it was clients that we closed a loan with last month, and ultimately now they're in a house. So we're going to talk a little bit about that, but it's really, you could be in your house 5 years, 10 years, and we know you're going to find some value with this. So that being said, Billy, I'm going to let you introduce yourself, and then we will get into the program. Billy, by the way, I am not a financial pro. Billy is. I am not licensed to give financial advice. Billy is. I might give some advice, but we're just going to say Billy gave it. So anyway, that being said, go ahead and introduce yourself, and then we'll get rolling with the program.
awesome. I appreciate it, Rich. Thank you so much. But yeah, my name is Billy Fitzgerald. I work for a financial planning company called Equitable Advisors. I've been doing this for a little over 3 years, and then I actually went to the University of Illinois and majored in financial planning. So lucky enough to say that what I wanted to do and aspired to do, I'm doing right. So, but like Rich said, I had my Series 7, I had my 65, my Series 63, life and health insurance certifications. So just kind of all over the board in terms of planning. I work with over 300 clients so far, just different
Great.
people who range of everyone's different, so range of people, and just trying to help put together all the puzzle pieces. So
That's
um,
cool.
yeah.
That's cool. Yeah, that's good. I mean, everybody's life is different, so we're going to kind of go,
Oh yeah.
we have a roadmap that we're going to talk about here. We do talk about it now a little bit more with our clients ahead of time, but we want to make sure we cover it at the end. It's really our wealth accumulator, and we're going to get into that in a second. So again, questions that you guys have, hit the chat box. Otherwise, we are going to roll on building a strong foundation. It really begins with home ownership. One of the things that we talk about in our home buyers class is the fact that the average net worth of a homeowner is about $197,000. The average net worth of a renter is about $4,700. That is a huge, huge difference. So the foundation certainly starts with buying a home. And so if most likely you're here, you probably have bought a home. But if you haven't, we do have a class that's first time home buyer. That might be more appropriate, but we're going to cover a lot of things that'll be post buying a home. So again, we all want to end up in the same place. Financial freedom could mean a lot of different things for people. Billy's got 300 clients. He's probably got some clients that want to sit on a beach and retire. He's probably got other clients that would rather not work, but literally donate all their time, energy, and effort for charity. Billy, what other cool things have you heard as far as people who literally what they want to do when they hit financial freedom?
Well, you kind of already hit the nail on the head. I have a lot of people say, "Oh, I'm going to Florida." They want that nice weather all year round, but a lot of the people that I talk to, if they have kids, it's being able to, if like, let's say their kids at school, away at college, they could go visit them, or it's just having that freedom also means peace, right? So having that peace that in retirement you're comfortable and you don't have to get up every day anymore and, you know, essentially grind. It's you're able to kind of kick off the shoes and relax and, start enjoying everything that you've built over the
There you go.
last.
There you go. And
Yeah.
honestly, if you want to keep working, maybe at that point, if you are financially free, then you work on what we call legacy. You're
Mhm.
working on leaving a legacy for somebody, even though that might be just continuing to work. So one of
Mhm.
my mentors basically said that he's looked, but he can't find anywhere in the Bible where it talks about retirement. So it's kind of funny.
Yeah.
It's like he should be working towards something. So, all right, we
Mhm.
talked about the fact that we start this process with buying a house. So post-closing financial advice. So if you've recently bought a home, and again, we invited our clients that closed a loan with us last month. So first of all, you obviously common questions we get: where do I send my payments? Typically, you'll get two different notifications. One is in your actual closing documentation, meaning the paperwork that you got when you closed. You'll find something in there. Two, you may get a letter a couple weeks later. I just talked to a client this morning, closed on the 29th. We sent them the letter on the 9th that basically says we at Cross Country are going to be their servicer. Here's the phone numbers, the websites, and all that other stuff. If you don't know where to send your payment, reach out to your mortgage person who closed your loan. It's really important you make the first one on time. So, can you set up auto withdrawal? Absolutely. The mortgage companies love it. You could set up the auto withdrawal out of whatever account you want directly to the mortgage company, so you're in good shape. Now, one other thing that I have to cover: the fact that you recently closed a mortgage that triggered something that's called the public record. Public record is when we recorded a mortgage in whatever county you bought the house. Now, what that also triggered is marketing companies that are taking that data and reselling it to companies that are now going to bomb your mailbox with all kinds of ridiculous insurance offers. So some of it's homeowners insurance, some of it's life insurance. We've seen lunacy, like an offer that basically says, hey, you could pay us to record your mortgage. And it kind of scares somebody into thinking their mortgage never got recorded. And literally, they want $50 to go get them a copy off of the online website with the county that you guys could do. So here's the thing: you're going to get this deluge of mail for probably the first 60 to 120 days. It may even look like it's coming from us. Immediately go to the fine print. In the fine print, it's going to say, we are not affiliated with Cross Country Mortgage. They know our name because, by the way, our name's on the mortgage and it's a matter of public records. Just know we did not sell that information. It's a matter of public record. Now you're getting all this mail. And certainly, if there's anything that's super confusing, because the way they package some of this stuff, it looks like it's coming from the government, looks like it's coming from us. Don't hesitate to reach out to us and say, hey, Rich, is this thing legit? More often than not, it's not. So just keep in mind that if you get those notifications, go right to the fine print. So since we talked about insurance, let's talk about, yes, when you closed with us, we required that you have homeowners insurance. Protects the house, something happens, it's great. But is the house protected? And when I say protected, I'm really talking about getting a will. A will is a very important part of your financial future. And certainly with the house, it makes a lot of sense. If you do not have a will, typically the state is going to basically decide what happens to your assets. Now, most of the loans that we close are in Illinois, but and if you're in Illinois, we know how they manage their money. We certainly don't want them managing ours. So it all starts with getting a will, which will basically tell your heirs where you want things to go. Wills are not that expensive. Tony and I, well, mostly Tony did a poll with probably about 20 different attorneys, and we found anywhere from $150 to $550 just to draw up a basic will. As a matter of fact, Tony, we needed to update the slide because we did find some company online. If she remembers it, I'm going to have her put it in chat. It was a company online that actually offered a will creating service, something very, very basic. Billy, do you want to talk about wills for a second on this before we move on to the next slide?
Yeah, of course. There's actually a few will and trust attorneys that I work with too, that if anybody who's watching has some questions, I can shoot them a couple different people's info as well too. Lot of will planning that I help my clients with or send them off to the trust attorneys. It's very important in terms of when you have insurance or when you have any type of retirement account, you list a beneficiary, right?
Yep.
Where do things go if in the event of you passing away, right? Well, a will kind of helps keep everything organized and very specific, because when it's up to the state, that's something called probate. And probate can be a very, very messy, long, and process. And
Well,
when
and
something's in,
here's an example, Billy, not to cut you off, but here's an example. What I see a lot that is an issue is you'll get two people that are together as a couple, but maybe for some reason, maybe they're not married, maybe it's their second or third relationship, it's a later relationship in life, and one party goes on the title, buys the home, gets the mortgage in their name, maybe for some reason the other party couldn't be on the loan and they kept them off the title, and now something happens to the person that was on title and their family kind of swoops in, even though that couple's intent was that was going to be their forever home. They had committed to each other, but because they weren't on title and it was maybe a second or third relationship, maybe a second or third marriage even, now the family's coming in and saying, hey, that was our father that passed away and your name's not on title, we're the rightful heirs. If you have a will, you eliminate all of that nonsense and all of those little infighting things that tend to happen.
you took the words right out of my mouth, Rich. If anything's in probate, anybody can contest it. So having a will or even having a trust is its own legal entity. So
right.
Creating one of those two things can help.
It's a huge deal. So
yeah.
How else do we protect the house? Well, we protect it with some life insurance. So, people don't buy life insurance, and here's a couple of reasons. It's scary to think about death. Bad news, guys, death and taxes. It's all of our realities. We're going to deal with it, and don't be foolish and not address it. So also they don't know what to get. And again, or how much do they need? Maybe they don't think they can qualify. How much they need and what to get might be a good conversation to sit down with Billy. But ultimately, what I wanted you guys to think about as my customers, or certainly the audience here, is if you're a single income household and the other person in the household is taking care of the children and something happens to that income, how do you want that person to carry on? I have just a horrible story that we had an agent, real estate agent, spouse was a stay-at-home mom, 3 kids. They bought the dream house in this market, probably worth $675. Back then it was $425, which was still a lot of house. Young man unfortunately perished in a vehicle accident. No life insurance, nothing. They just bought that house. Because of that, I guarantee you, she didn't stay in the house. The kids had to move back out. We don't know what happened to them. I mean, we, of course, as an industry, tried to help out a little bit, but ultimately, that's not a position that you want to leave your family in. You want to either have money to replace income that's gone and or eliminate the debt and then give them enough income to live on. How do you determine how much? You sit down with somebody like Billy and say, hey, how much life insurance do I get? Now, I also want to talk about life insurance real quick. We love term insurance. We do not like whole life insurance, universal life insurance. There is a huge difference. Term insurance insures, that's it, insures you for your life. It is not an investment vehicle. Why don't we like it as an investment vehicle? Because people that do what Billy does, that's the best product they can sell. They make the most money on it. I don't agree with that product. It is the way that they make the most money. We talk about using simple term insurance, and it's why Billy and I talk. We were on the same page. We said, hey, look, term insurance is the way to go. Universal, whole life, those things are not good. You want to, most of our folks are pretty young. And actually, I believe we have a nice little graph right here of what insurance would cost you on for a 20-year term insurance. This is the average cost for a $500,000 policy. Annual cost, if you were 40 years old as a male, $340 a year is less than $30 a month. That's pretty significant. So, Billy, what do you do when you sit down with maybe a younger couple? How do you decide how much term insurance that they should have?
So that's something called a needs analysis, right? And just as you hit the nail on the head, you want to take a look at what you already have in place, but also at the same time, you want to take a look at what debts do you owe. Mortgage is always the big one. Student loans is another big one. But another thing that is pretty common that people overlook is that income replacement aspect. And a story I have, actually, it's I kind of love to tell this because it kind of made me feel good. It was one of my clients. He has 2 twin baby boys, and this was beginning of the pandemic. And he called me and he's like, Billy, my wife is having another baby. We got another one on the way. I need life insurance. And he called me and I'm like, all right. And then we kind of talked everything down. It's the middle of the pandemic. And, it was just nice that was like, he just knew there was the need. And he has the twin baby boys are now toddlers, but now he has another infant. And, we were able to insure him. He's a 35-year-old guy. He's in great shape. He's paying for $1 million in term insurance over the course of 20 years. He's paying about $34 a month. So it's
crazy good.
We were able to help him out, help his wife out, protect his family, because, his wife she's at home and she's raising 3 babies. He's the breadwinner. So if anything were to happen to him, right, she has a lot on her plate. And
yeah, so I mean, that's and ultimately we want to make sure. So again, foundational pieces. We got a will, we got insurance to cover the what ifs in case something happens. So we cover that. One last piece I want to cover here, Billy, is I heard last year during the pandemic, it might have been towards the end of 2020, beginning of 2021, insurance guys had reached out to me and said, hey, they're doing up to 500,000 insurance and they don't care about pre-existing condition, or maybe they're just not doing a medical exam or something like that. Was that something that had happened during the pandemic back then? Did you hear that?
I personally didn't.
Okay.
I know my company, if depending on the insurance application and then the medical records, you might not even need that exam. But most companies, it's a registered nurse will come to your house, and then it's a blood and urine exam. And then from there, that's basically the insurance company kind of being able to rate you a little bit better. But
is that when you get closer to $1 million, or even at 500,000, you might get that type of inspection?
Yeah, about 500,000. If there was anything
Okay.
that on the medical records that was a big ding,
Sure.
like diabetes or something like that,
Sure.
then that's something they'll be like, hey, let's make sure A1C levels are okay. And then if they are, then you'll get a good rating.
Perfect.
But also something too, just in terms of why insurance, right? You have the house, you get homeowners insurance. You have a car, you get car insurance, right? We don't go driving on the road just planning to get in an accident, right? Accidents happen. So we get life insurance, not because of the probability, but because of that outcome, because of that exact what if, right?
Right. Yeah, and that's what we do. I mean, we've got to make sure that we insure some things and make sure we keep the people who survive us. We want to make sure they have the life we intended for them to have when we were around. So if you guys have any questions, put that in there. I noticed Tony put the website we found for wills called epicwill.com. That was in there. In the meantime, we're going to go to the next slide, which is where do you go? Who can you trust for this kind of stuff? We bring a great financial advisor on here. Certainly you can go to a financial advisor to get term insurance. We have recommendations for people. Even your homeowner's insurance agent may be able to get you or steer you in the direction of getting some term insurance, but the key is you want term insurance. Some of your homeowners agents may try to sell you some of the other products. Just remember, on those products, the only people that make the most money are the people that are selling them, my opinion. All right, so let's talk about financial freedom from a standpoint. We've protected our house, we've got the will going, but we have to pay ourselves first. So these are philosophies that we've taken from great books out there, like The Latte Factor, the Millionaire. Was the one book, Tony, that we were just promoting? She'll remember that. So The Richest Man in Babylon is another great book that talks about paying yourself first. And The Millionaire Next Door, I'm sorry, that was it. So that being said, how do we pay ourselves first? So, that's an important part. And this is going to be a segue too. We do teach another class on budgeting, but we're just going to talk about how we would do it. And then we could show you the budget class at another time. So you want to pay yourself first. Say you make 8 hours a day, you work for $18 an hour. Could you save $18 a day? Save that first $18 a day. If you did, you'd save about $4,600. Not so bad. How paying yourself first, what do we do with that savings? Well, ideally, I want to do two things. I want to eliminate, if you have credit card debt and you have no emergency fund. What's an emergency fund? Should be 3 to 6 months of whatever your survival number is. Holy cow, Rich, what's a survival number? Okay, so at the end of the month, when you cross over into the new month, you should go into your checkbook where you do pay your bills and determine what the minimum payments are for everything that you need to pay. Gas, electric, insurance, phone bill, whatever, cable, whatever it is that you're paying for. What's the minimum number? Not any overpayment, but what's the minimum number? Food, gasoline, whatever. That's your survival number. Let's say it's $3,000 a month. That's what you pay out a month. Now you want to have an emergency fund that's anywhere from 3 to 6 months of that $3,000 a month. Now, how do you determine 3 to 6 months? We really just talk about how long you think you might be out of work if you lost your job. So some fields, pretty easy to get a job the next day. Other fields, think about people that are in specialized things, maybe higher paid executives. It's going to take them longer to land the job that's similar to what they had. They may want a 6 months reserve versus a 3 months reserve. But what do we do if we've got no reserve, no emergency fund, and we have credit card debt? So a lot of people would tell you, pay off the credit card debt first, forget the emergency fund. I disagree. So what I would have you do once you made all your minimum payments, let's say there's $200 left over. We're going to take $100 and pay it towards credit cards. We're going to put another $100 in our savings account. So we're going to do both of them at the same time. The reason we're going to do that is because if something happens, tires blow out, hot water tank goes out, you're immediately going to go back to a credit card if you don't have an emergency fund. If you have an emergency fund, you can stay out of that credit cards, hit the emergency fund for that emergency, and keep paying down the credit cards. Speaking of credit cards, how do we pay off the credit cards if we have a lot of credit cards? Traditionally, what you do is you take your credit cards and you list them. A lot of people would say list them for the highest interest rate to the worst interest rate. It's not the right way to do it. You're going to list those credit cards from the smallest balance to the largest balance. And nobody on that piece of paper gets overpaid except for the person on the top. Everything you have left that's not going into your emergency fund to build that up is going to that first credit card. So if it's a couple $100 credit card, probably going to have that paid off in a month or two. When you get down to the bigger credit cards, the larger ones, you'll have paid off all the little and the medium ones. Well, you'll have all those minimum payments to start really denting the big credit cards. So that is the way that I did it. And now I hear it taught all over the place. So you want to, again, at the same time, get rid of your credit cards, build out the emergency fund. Then after we do that, the other thing we do to pay ourselves is the 401k. 401k is one of the greatest savings instruments on the planet. I have to go back and see. So I want to talk about, we'll go back and talk about survival number for a second. This is the budget we have. If you're interested in getting a copy, we not only have this in paper, but we have this on an Excel spreadsheet. So things will carry over from one month to the next. It'll show you how to calculate your survival number, which is right here in column 2. Billy, I'll send you one. So this is one that me and my wife have used every month consistently for the last 5 years. Speaking of that, if you do have a family budget like this, it is something where typically in a house, one person pays the bills and the other person's like, I don't know, just tell me how we're doing. So this is a form where you can sit down with the other person in the house and say, look, this is what we made. This is where it went. This is what we've saved. And this is where we're at. This one form right here can save a marriage, because you want to know about money? Don't guess, don't yell at each other. Go back to the form. Everybody knows exactly what's going on. Last key part of having a form or having some version of this, if something happens to the person that's paying the bills, the person that's not paying the bills is going to have at least a reference point to begin to figure out the family's finances. So this is a sample of what a budget looks like when we teach our budget class. This is kind of how we break it down. The form actually defaults and actually already calculates what the 3-month survival is. In our example that we do for our class, this particular person had about 4,000 in. They saved about $782, which was 16% of their net. We track all that stuff. Ideally, you want to save 10% of your income, net income every month, and build that possibly up to 20%. Again, those are different concepts that are talked in easy to read books like The Latte Factor, again, The Millionaire Next Door, easy to read book stuff, and they talk about all this stuff. So again, we'll cover that. Now, the big stuff, 401k. So you've got your emergency fund, you've gotten rid of your credit cards. Now we talk about the 401k. The 401k is one of the best savings places in the world. First of all, because you're putting money in tax-free. You automatically get a return by not paying taxes on this money, and the money goes directly into your savings for retirement. So if you're in what's the average tax bracket in America, Billy? I'm hitting you with this one on.
About 22%.
Perfect. So for every dollar you put in that isn't taxed, now that's federally, right?
Federally, yeah.
What's the state of Illinois?
5%, I believe.
Perfect. So now we're talking 27% in taxes that you save by utilizing a 401k. So right off the bat, you're ahead of the game by 27%. Pretty good. Now, most employers do a match. In that match here across country, pretty simple match. We match 50% up to the first 6%. I don't know, Billy, what's average in the country for the way companies do it? Do you know that? Hitting you with some tough questions.
That really ranges on different companies, but if we're just going on like your large companies, your Googles and stuff, 6% is pretty average. But sometimes as you scale up, sometimes they'll even match up to 10%. So
cool.
And
so go ahead. I'm sorry.
No, I was going to say what's really nice about the 401k is the fact that the employer has a match, because that's essentially free money.
It's free money. Yeah, we were just going to get it. I mean, it's perfect. I'm glad you said it. So we save 27% in taxes. And in my company's case, we automatically made 50% on the first 6% of money that I put in there. I made 50%. Stock market didn't have to do anything this year. And I saved 27% in taxes, and I got 50% from my boss. Thank you very much, Ron. He matched my retirement funds. Most companies have some sort of match. If you're not taking advantage of that match, it's free money. You should look into it and take it. Now, I strongly encourage all my employees to get involved in the 401k. Some of my employees, it's taken me 3 years to convince them to get into the 401k. Now that they are in the 401k for 3 or 4 years, they're like, this is bananas. I can't believe how easy this is and how much money I actually have. Now, Right now, the stock market's getting its beaten up. Billy's probably taking phone calls from worried investors during the week. The stock market gets beat up. This is a correction. This is normal. So this is a normal thing that happens. On average, the S&P 500, as an example, as somewhere, if you just said, hey, I don't know where to put the 401k money, see if we cover that on our next slide. Here we go. So this is what the stock market has done over the last 30 years. So if you had started out with, looks like our little meter there starts out at about $5,000 over the last 30 years, that could be up to as much as $30,000. The S&P 500 has had, in the last 15 years, an average return of 12%. In the last 25 years, the average return's been 9%. Now, what the heck is the S&P 500, Billy?
The S&P 500 is essentially the top 500 companies just averaged together. So you take that average, and that is basically a market indicator or a market index of how the market in general is doing.
Sure. So here's the thing, guys. One of the other reasons people don't invest in a 401k is they don't, oh my God, where would I put the money? I'd actually have to make some decisions on where to put the money. There's a couple different options that you have. Number one, you could talk to somebody like Billy and say, look, I want to start investing in my 401k. Here's all my options. And Billy's going to do, I think you called it a needs analysis.
Mm-hmm.
Perfect. Billy's going to do a needs analysis based on your age and your investment risk tolerance. He's going to say, hey, these are great funds. These are how you should invest. Now, if you don't have somebody like Billy, the company you're investing with probably has some quick little quiz that you can take based on your age, your risk tolerance, blah, blah, blah. And it'll tell you, hey, based on these things, these are the funds that we recommend. Or you can keep it super simple, and you could just put the money in the S&P 500, which has averaged 12% return for the last 15 years, or 9% over the last 25 years. Just go right into the S&P 500. So that might not be the best way to go. Reach out to somebody like Billy, but if you don't want to think about it, sure. And then Billy will tell you, as you get older, you might want to actually diversify a little bit. So that's what we talk about in some investment accounts. So this is kind of our wealth accumulator that we talk about. Number one, own a home. Number two, have a will and some term life insurance. Get yourself 3 to 6 months worth of liquid reserves. Max out your retirement. If you're nervous about what your net check's going to look like with your 401k, take a little bit out. Take 1%, take 2%. Couple paychecks, you're going to be like, wow, I don't even miss that money. What's going on? Go back in, take 3%. Take a little bit more as you feel more comfortable. Put more money in to the 401k. One of the things that is also nice about a 401k, it does something for you called dollar cost averaging. Every time you get paid, you buy stuff. What's dollar cost averaging, Billy?
Dollar cost averaging is essentially as you contribute systematically every 2 weeks, right? Every paycheck over the course of time, right? So as the markets go on up, and then sometimes when it's going down, and then it's way up and it's way down, as you systematically contribute through the peaks and the troughs, right? The highs and lows, you get a better average dollar cost for what you're investing in compared to if the market's really high right now and you buy then, and then it drops and then you sell, or vice versa. You just, it systematically does it for you just by automatically contributing every.
So you're buying stuff when it's cheap, you're buying stuff when it's inexpensive, and ultimately, and as an average, you're in good shape because you're not buying it all when it's really high.
Time,
yeah, and you're not trying to guess to buy when it's all really low, which is good. Now,
there's a saying called time in the market is better than timing the market.
Yeah, I like that a lot. So this fourth slide here talks about, okay, you've got your 401k maxed out. Maybe you've got some extra money that you want to invest in cash. So your 401k is great, but you really can't get to that money until you retire. You now want to start building some cash outside of the 401k. Well, how would you do that? You could invest in mutual funds. It's possible. One of the gentlemen that is one of my business mentors says, hey, invest in like 5 stocks, individual stocks. And he uses the Warren Buffett method. Invest in companies you use, companies you know, companies you like. Warren Buffett goes to McDonald's every morning, buys a Coke. Those are companies that he invests in because he knows those companies. He likes those companies. Now, as an individual stock investor or a mutual fund investor, here's my warning to you. How many mutual funds last year beat the S&P, Billy?
It's that I don't know off the top of my head. I know it's possible, but it's not.
Probably less than 10.
It's
So
not very common.
it's not very common. So big guys out in New York driving big cars and big fancy offices, running huge mutual funds with millions and billions of dollars, they don't beat the return of the S&P 500. So hate to beat that drum, but if the measurement of you did really well as a mutual fund manager is I beat the S&P 500, why don't you just invest in the S&P 500? Just my opinion on that. It keeps it safe and easy. So what would you say to somebody who wants to just keep it simple but has some money to invest, Billy?
So you covered a lot of good stuff there. For someone who has extra money outside of, and they're already doing what they can towards the retirement, if they're just looking to invest, I really like index funds, and I do like mutual funds. There are some American funds is a really good one that I use a lot. They have, what's nice with the mutual fund.
So let me interrupt for one real quick second, because again, I want to try to basic this out. So mutual fund is somebody's running a fund and they're picking a bunch of stocks. So I think a lot of people know that, but that kind of breaks it down very, very easy.
Think of a mutual fund as a basket. And within that basket, you have a little bit of Tesla and a little bit of Amazon and a little bit of Google. Whereas if you just own an individual stock, you're a small fractional owner of Tesla.
Yeah, pretty cool. You could say you're an owner of Tesla, even though you only have one share. So you mentioned index funds, and that's kind of why I stopped you, because I wasn't sure anybody really knew mutual funds, but we covered it great here. What's an index fund?
An index fund is essentially when you talk about the S&P 500, right? And the S&P 500 being a market index. There's certain companies that are the S&P 500, like Vanguard does, Fidelity does. It's just an index fund. It's passively managed, which means there's not a fund manager actively buying and selling and whatever it is in between the fund. It's just whatever the market does, this does.
Yeah, that's perfect. That's perfect. So we are open for any questions, but I want to get into, and I think Billy and I talked about this briefly, but some of the things we talked about, Billy will appreciate this. Did you see these slides, Billy? Did we go over this stuff with you?
Not when we did the review, no.
No, this is good. Yeah, we added these late, and we've been actually promoting these in some of the videos that we got coming out this weekend. But so we're going to cover two things here. One is we're going to cover recessions, and the second thing we're going to talk about is, and this is an add-on. It's kind of special because it's media. The media is talking about recessions. Yes, no, we're going to have one. Housing bubble. Oh my gosh. Yes, no, we're going to have one. So I like to look back at history, because history tends to repeat itself. So, and I talk to a lot of my clients and I verbally tell them what I'm thinking. Let's look at some charts and really dial into what's going on. So first of all, this right here, this blue line on this huge chart, you should see, it's huge on my screen, is the Fed raising the Fed funds rate. Right now, we're in a high inflationary situation. They are raising the federal funds rate to try to slow inflation down. Now, interestingly enough, we have these gray bars on here. Those gray bars that you see on there are recessions. So if you look at the blue line going up, and actually we'll see here, can you guys see my cursor in there? So you look at the blue line going up, recession. Blue line going up, recession. Blue line going up, recession. Blue line going back up, recession. Now, sometimes it goes up and it doesn't cause a recession, but most of the time the blue line goes up, you'll see a recession. And right now, this was printed after the Fed fund, or this was printed before the Fed funds rate that they've been increasing this year. We feel that a recession is pending. Now, I don't have to be brilliant to tell you guys there's a recession in the future, because just like death and taxes, it's all of our futures. There's going to be a recession, but what I'm going to tell you is that we believe one's coming in the next 12 months. Go ahead, Billy.
Well, You hit the nail on the head. It's the economy goes in cycles, right? So for the last 4 years, 5 years, we've seen great returns. We've seen the market be a bull market, meaning it's going up, right? So it's just a matter of time for what comes up must come down eventually, right?
Yeah.
So that's kind of what you were talking about.
Yeah, exactly. But now what we're going to talk about today is that there's a recession coming, we believe, in the next 12 months, and here's why. So here's the next part of it. So what happens to housing through a recession? Because you're getting a lot of people that are matching housing bubble and recession. They're pairing them up like they're married. That's really not true. And again, history will tell us that that's the case. Here's the last 9 recessions going back all the way to 1960. The last 9 recessions that we have. By the way, Billy, what is the definition of a recession?
A recession is essentially a deep economic slowdown.
So 2
So,
quarters, right? 2 quarters of negative GDP.
yep, for at least 6 months. So 2 quarters.
Correct. 2 quarters, so 6 months worth of negative gross domestic product or negative GDP. So here in this, we talk about right now, this white line in here is essentially what's going on with home values from 1960 all the way up to where we were at roughly now. Now, this is every one of these, I guess in this particular chart, every one of these black bands are the recession. And you'll see as we go up here, maybe a little bit of a decline, a little bit of an increase, a little bit of an increase, sharp increase in the 80s in housing. Here's another one in the 90s, a little bit of an increase. This is a sharp increase for the recession that happened in the early 2000s. Now, the only one that sticks out is the housing bubble. So by the way, that's what caused the recession, was the housing bubble. This was a recession caused by housing. We go back to the last recession that we talked, the last recession, which essentially was the pandemic, and houses just shot up. 8 of the last 9 recessions, housing stayed the same or went up, with the exception of the one that was tied to housing. So let's go to the next slide. What was going on in 2007 versus what was going on today? 2007, we had 3.7 million homes for sale. Currently, now this chart only dates back through March. Right now, it's still under 1 million homes for sale. So we have under 1 million homes. The average since 1983 is about 2.5. We have under 1 million homes for sale. So when we had a huge amount of supply, yeah, it created that we had that recession, had the housing bubble, ton of houses for sale, and nobody really to sell them to. So here, March inventories, and this just makes it a little more dramatic than the last chart, 3.7 million in homes for sale versus under 1 million. But here's the biggest thing right now. Back in 2007, the United States had 116 million households, 116 million households, not home, but families that would need somewhere to live, whether it's a house, rental, whatever. The number of households in the United States ending 2021 through immigration, through natural birth growth, there's almost 130 million homes. Guys, we're talking about 14, I keep saying homes, but it's really 14 million households that need somewhere to live from where we were just 14 years ago. So now we have less than 1 million homes on sale, and we have an extra 14 million people that need somewhere to live. So now going back, then we're just going to jump back to that slide real quick. Do we think there's going to be a housing bubble with this? No, because there is a dramatic need for housing. National Association of Realtors, National Association of Builders have all said that we are about 3.8 million homes behind what should have been built by home builders at this time. Reason for this was the home builders all got their rear ends handed to them back in the recession, and they didn't build at the pace that they needed to build. Now in the last 2 years, they have other issues, labor, supply chain issues, pandemic shutting down job sites. They're even more in the hole as far as what they really needed to deliver to make sure we had enough homes out there. So we don't believe that there's a housing bubble. And before I get into the recessionary screen here that we're going to talk about, will there be markets that, well, first of all, the media is going to have a field day with anything that's negative for housing because it gets your eyes to the screen. So if appreciation goes from 28% like it was in Phoenix and Miami last year, and it drops to 4 or 5%, as far as they're concerned, the sky's going to be falling. By the way, 5% appreciation is still pretty good, and that's probably means more healthy market. Are there going to be some markets maybe around the country that see a little depreciation? Sure, maybe, because they're oversold, price points are insane. But a global or a total country housing bubble, there's just not enough houses for the people that need them. And what's your alternative? Is it to go rent? It's really not a great alternative. Landlords right now are requesting 700 to 720 credit scores minimum, and they're requesting that the renter, the tenant, has at least 3 to 4 times net income to whatever that rent is. Those are the standards today. It's not any easier to rent a house than it is to buy a house. Actually, it's easier to buy a house because guess what? I'll go 40% of gross on somebody, and I will definitely go below 700. There's plenty of programs, Fannie Mae, Freddie Mac, FHA, VA, they all go below 700. So I can actually get somebody in a home a little bit easier. Now, let's talk about this recession in the next 12 months. So interestingly, I had a conversation with a counterpart of Billy's, not in his group, but in another thing. And she said, no, there's not going to be a recession. I didn't get a chance to share this stuff with her, but these are the facts. Headline CPI, which is the Consumer Price Index, that's how the Federal Reserve measures inflation. If as a quarterly measurement, it goes above 5%, historically, 45% of the time, we get a recession. Now that happened in the second quarter of 2021. We're going into the second quarter of 2022, or we're in the second quarter. Is there a recession? Probably not. Still reporting a lot of high inflation. So I guess we're on the 55% of that factor. But here's the next one. Unemployment, when it goes below 4%, 42% of the time, that means we will see a recession in the next 12 months. Unemployment went below 4% in the first quarter this year. Last but not least, and this is really what kind of ties it all up for you guys, if consumer price index is above 5%, unemployment's below 4%, that is 100% indicator, at least historically, that we'll see a recession in the next 12 months. That happened in the first quarter of this year. Do I believe there's a recession? History would tell you that there is. So that being said, do I think it's going to impact housing? No. So if you want to know how to maybe protect yourself a little bit better based on a recession, you'd want to talk to Billy. Like, how do I maybe prepare myself for that? Talk to Billy about that. But we wanted to cover those important things. If you found this interesting, we do this program probably now every 3 months. We're going to do this program. Our next consumer basic program is going to be on taxes. Next month, we're bringing Ryan Shafkis in. He's going to talk to our homeowners, borrowers about how to read your tax bill, and most importantly, how to maybe contest it with the township. Tax bills are coming out. I'm already hearing from my clients that the taxes are up. Already, because of the way Ryan taught me, I actually walked through somebody's entire tax bill, made sure they had their homeowner's exemption, and determined what value that they were actually measuring on the home. So that's going to be a great program. That's going to be June 25th. Billy, do you have any closing thoughts for everybody?
Covered a lot of really good stuff. Going back to the 401k, that's kind of the one that was sticking in my head the most. Is for some people who, let's say your job doesn't offer a 401k, and like, let's say you're a teacher. Let's say you work at a non-for-profit. Your version of a 401k is a 403b. Same concept, just different tax code. Or let's say you're already doing a 401k and you want to do stuff additionally for retirement. You can do an IRA. Or if you have your own business, you could do something called a SEP IRA, SEP. So there's other different retirement vehicles too, depending on your situation. And I help clients set up SEP IRAs if they have a small business or if they're a 1099 employee. I help clients do IRAs all the time, 403Bs. It's just what's your situation. And like I said, kind of having those puzzle pieces and finding the best way to make that picture in retirement.
Yeah, That's perfect. That's well put. So we got Billy's information is here. Billy, thank you very much
Of
for being
course.
part of this. We look forward to doing a lot more of this stuff. My commitments after seeing really what did happen to some of our clients during the housing meltdown was to try to give back, make sure that we're educating our clients as much as possible, make sure that we're not just here for them to put them in a home, but make sure they stay in that home and continue to get their dreams satisfied. So we do appreciate everybody in attendance. And Billy, again, thank you for your time. Tony, enjoy your vacation. You will be missed. And thank you, as always, for putting this on and making sure that we're together and helping me get that little dragon in the background. She knows what that's about. But Billy, thank you very much, buddy. Hopefully we'll talk soon.
Yep. Take it easy, guys.
Bye,
Have a
guys.
great night. Bye.